Good evening. Good evening, everyone. My name is Adam from Trade with Precision. The very first thing I want to do, please, is just check the sound is good. If you can hear me loudly and clearly, that is fantastic. Welcome to tonight's webinar with me. The topic tonight is the stock market. When will it stop? Which is meant to be more of a when will it stop dropping, as opposed to when will it just randomly stop. We've got a couple of disclaimers I need to give you an opportunity to read through, and while you're doing that, I will tell you a little bit about myself. So if I recognize some of the names, but if this is your first webinar with me, then please let me know. Just give me some feedback there as well, because I'm going to repeat some of the elements that I've covered in previous webinars in terms of analysis, because obviously we're doing this on a weekly basis and the markets are updating. So I want to follow through on what we were, what the price action was telling us in the last webinar versus kind of where it is now. So just use the questions box. If you have anything you want to say or add to it, just use the questions box to communicate with me. As I said, I recognize some of the names. So my name is Adam. I am one of the traders and analysts with Trade with Precision. I am usually based in the city of London in the United Kingdom. However, at the moment, I'm in Spain, I'm in Marbella, and I'm on my way back to the UK tomorrow. Sort of a bit of a working holiday being based over here. So I am a technical trader, which means that I trade price action, candlesticks, support, resistance levels, moving averages, Fibonacci levels, pivot levels, and so on. I trade, I've been doing a lot more day trading in the last two and a half years. It was very much during COVID, I got back into it, very much enjoying it. And I provide global markets analysis, obviously various different, I do that as well. So I do trade a multi-account for clients, but it's not a solicitation, just giving you some kind of background. So I actually trade for a living, but also I can get quite lonely because obviously I'm just isolated. So thankfully this week it's mostly with family. They've been bearing the brunt of it. So we are going to be doing a market analysis for the S&P 500 as well as the other major indices. I want to have a look at the Australian ASX, the German DAX, the UK FTSE. I'd like to do that. If there's another one you want me to have a look at, just tell me now. Have a look at the recent movements within the FANG stocks, and then a potential watch list, to keep an eye on through multiple timeframes. So what I'm going to do now is let's go across to the platform. I want to set it up. So because I'm working off my laptop, I didn't copy across most of my settings, which is not a big deal. We're just going to go through it now, and I'm going to show you how I do this. I'm going to use these spot charts for now, just because it's easier for me to do that, and just create a little bit of a watch list and the ones that I want to use. So I'm going to start off with the Dow, which is the oldest one. I'm going to add the S&P 500. Then I am going to, I'm looking for tech stocks. Then I'm going to go ahead and throw in the UK FTSE, the DAX, and finish off with the ASX. That's it. The French CAC and the Euro stocks are really going to follow the DAX for the most part, so they're not required for the purposes of tonight's analysis. And then we've got the Nikkei. So if we really want to be thorough, we can go ahead and do that, but it's not too much of a big deal. Let's see what we've got left over. We've got China, Spain, Hong Kong. Hong Kong is similar to the Japanese to the Nikkei, so we don't have to stress about that too much. We've got the Russell 2000, so it's really, I love the history of it. The history is very cool. We had the in the US, they started the Dow Jones Industrial Average in 1893 or 96. I think it was 1896, and had 30 companies listed in there. And then, of course, they ultimately produced Standard & Poor's, produced the 500 mid-cap to large-cap companies. So that's great because that's a great sample size globally of, although they're American companies, it's like McDonald's and Starbucks, you have them locally. So depending on how well they're doing, it's actually a really good global indicator. And then below that, we then have the Russell 2000, which is 2,000 small cap companies as well. So between the S&P 500 and the Russell 2000, you have just a phenomenal sample size of companies around the world. And it's a fantastic indicator of global health, or the state at least of the markets. So I think we should include that for that purpose. I want to have a look at how that is doing. And then, if there's anything else you see here, but I'm not swayed by any of these. And it should actually be the German. We've got the Nasdaq, obviously, which is tech stocks, and some of those are included within the S&P 500 and the Dow. So there's some overlap there. Now, Also, they're going to have individual stocks, so we could go ahead and have a look at these if, for example, we wanted to have a look at any of the ETFs. So triple Q is always nice if we want to have a look at that. That's not really going to be my baby. I think what I want to do here is let's go ahead and have a look. We'll have on the New York Stock Exchange, we're going to have Abbott's there's quite a few amazing ones. If there is something in specific you want me to have a look at, we'll do that. But let's go ahead here and have a look at Apple. So we'll throw in, we'll do the FANGs. Okay, so we'll do Facebook. We'll do, Meta, which is obviously Meta, I beg your pardon. Yeah, does that look right? That doesn't seem right. Let's go with Facebook just to double check. No, that's it. Then we have Apple, we have Amazon, which is great, which is here. We've got Netflix. We've got Google, which is Alphabet. There we go. And I'm going to throw in a few more here. I want to throw in Microsoft. I want to throw in Costco. I want to just see a few things here. Let's talk a little bit about equities that can do well during a recession. Okay, pretty cool. Shall we throw in Tesla? Why don't we throw in Tesla? Let's go and have a look at some of these tech stocks as well. Let's also see if we can find ARK. So if you've got ARK, do we have any of that? Or ARK? Is there another one? Tech, there we go, thank you. We've got that one. And let's have a look at, that'll do for now. We can kind of kick off with those and we can add as we go. So this will give us plenty to have a look at. I want to see also, should I have the dollar index, which I don't think we do. Oh, we do, holy cow. Dollar index, let's look at euro dollar because this is obviously quite important. Euro versus that, we'll have that one in. And then we have got dollar yen. Let's have a look at some of those dollar yen pairs. Gold. They're all connected, ladies and gents. It's a really good thing. Over the years for me, I feel like they have become, although they are different markets, they can be correlated, and so we want to have a look at that. They are connected, not strictly doing that. What's going on with dollar yen here and my euro dollar? Was that a problem? Do we have to add that one? Is that really the one that we want? And euro dollar? Not sure. Okay. We'll get rid of the other ones. Anything else that I like the look of? Oil. So let's do crude. Let's do West Texas if we've got that. Crude oil, we'll stick with that one. And then we've got Brent, which is here. Let's do this one. Cool. Plenty for us to have a look at. I love this. This is great. Okay, so just so you can see what I've done on my chart, simple candlesticks with the 50, 20, and 10 simple moving average, no exponential. It doesn't really matter. The difference between the two is negligible. It's like a 10% difference in terms of where the location is. Not enough to significantly change the analysis or my trading outcomes, really. I've also got a little clock app that I put on here. So if you're curious about that, it's a little indicator that I went and found. It's just a candle countdown I've thrown on. So I've always got a sense of what's going on. Also, by the way, if you hit your spacebar, this is a random thing, but if you hit your spacebar, it opens up a little window here at the bottom, and you can, for example, you can type in 1440 or let's say 240, which will give you a 4-hour chart. So if you wanted to randomly change the time or the instrument, you could do it that way. And I'm using a MACD and RSI indicators. So these are pretty much bog standard settings. The MACD is always default. The default settings for MACD are the best, by the way. For 99% of all purposes. So default settings for MACD, just leave them as they are. RSI, all I have done here is drop the value of it, which increases the peak to trough difference. It doesn't produce different signals. It just magnifies like a volume dial. It just magnifies the peak to trough things. So I'm really using it here to give me a sense of, I'm using the two of these for the same purpose. Let's go up to 10 and see how that looks. It just softens it. So I'm using the two of these as momentum indicators. They serve the same purpose. I'm using two different ones to give me the same signals, really, just to make sure that I'm getting those signals. They're particularly powerful, ladies and gentlemen. They have three purposes. Okay, these momentum indicators, it could be Williams percent R, it can be CCI. If you're a newer trader, and this is very new to you, please don't be intimidated. by anything that I'm saying here. Most of this is pretty straightforward. You'll pick it up in time. And again, if you're already familiar with it, I don't mean to offend you by kind of teaching you or mentioning stuff you're already very familiar with. So these, if you think about how we have price over time on the charts, these two indicators measure speed over time. They're very good at determining whether price is speeding up or slowing down. So when you think about it, if a trend is very strong, if it's gone from a consolidation and it starts trending, these will start to accelerate. They'll pick up. In fact, one of the best ways that we use them in the city, very reliable, 95% reliability when we're using them, is not necessarily the traditional way. We are not interested or concerned with oversold or overbought aspects of these indicators. We're not concerned with moving average crossovers. We're not concerned with histogram aspects of the MACD. All we're really interested in is if the trend, I'm just going to change the color of my drawing pen here. If the trend that we're seeing on the chart is producing a similar trend on the indicators. So in other words, if price is trending up on the chart and the indicator is also trending up, and they're both doing that at the same time, we have a strong, healthy trend. It's a very reliable way of doing it. If the trend, price action is trending lower and the indicator is also trending lower, meaning it's bearish, we have got an agreement. It's called convergence between price action and the indicators. The problem we have, which depends on how you want to use it, it can be useful to us, is when we get a discrepancy. So you get price that is producing fresh lows, but your indicator has started to trend upwards. So we call this divergence. This is now bullish, so it's bullish divergence. And so there's a disagreement. And here, for example, we can see it. Here is a fresh low on euro dollar. So you know recently history was kind of made. I say history was made, not for the first time, but we broke through parity. And so we can see price broke through that and then pushed back and is now kind of trying to work its way back up a bit. It's trying to do that. And what's interesting here is that if you look, if you go back, although we had a nice strong downtrend here, it sort of slowed down. And we can see that the MACD started to trend higher. So there's actually an exact point where it starts to, where we would say that it starts to happen. What I'm going to do here is I'm just going to draw a line straight up and down here. And just do this. We'll just talk about this gap here. We could see the market producing these lows and going from there down to the low. If you recall, there was a bit of a spike going down to that. You can see at this point that MACD is clearly trending higher, as is the MACD. Okay, so the MACD meaning that at this point, it's starting to produce fresh highs. It's starting to trend higher. It's a bit choppy on this one, but it is trending higher. And so we have bullish divergence. That's going up, that's going up, this is going down. It's bullish divergence. It's usually a strong, reliable indicator that the market is running out of steam. So there are three ways in which we can use this. One is to stop me from selling or getting into a trade because the trend is losing steam. So it can help reduce risk, reduce losing trades by alerting me to the fact that a trend is running out of steam. This is going to come into play when we look at the S&P. So everything I'm saying now is very relevant. So, so hopefully you're not finding it boring. Two, so one is it can alert me to where the risk is increasing because the trend is starting to lose steam. Two, it can alert me, it can confirm for me that a trend is still healthy. Because I mean, we've got no guarantees in the future, but what we can do is listen, if all the boxes are ticked and all the lights are green, we have the best chance of success. And so if these are convergent with price and that price is bearish and they're bearish, or price is bullish and they're bullish, that's just as much kind of green stuff in my favor that I can get. So that's the second thing. And the third thing they can do is they can then alert me to the possibility that that there might be a new trend about to occur, meaning I have a trend to the upside and it starts to lose steam, and I'm looking for maybe if it can go into a downtrend, I can get in at the beginning of the new downtrend. So very important. This brings me to a very important point, crucial. We always make our decisions off price action. So the decision to get in, get out of the markets is always based off what we see on the chart. A master trader, so that's every trader's goal, on their journey, which could be a 2-year journey or a 5-year journey, which depends on the individual and the pace at which they want to go or the pace at which they're kind of forced to go, is to get to a place where there's less stuff on your charts. So it's cleaner, simpler, and you're ultimately dealing, ideally, potentially with just naked price action, meaning just candlesticks. So the two minimum things that we need on a chart is going to be support resistance levels and candlesticks. That's the bare minimum that even the most superior traders will tend to trade with. Okay, why is that? Well, because everything's about price. So you've got your fundamental investors and analysts and traders, and they're looking at price. But if you took all of their data and you converted it into a chart, you would get what we see here. So what technical traders see are the visual representation of the fundamentals, actual orders being placed in the market, because the market only moves when a physical order is placed. So we're not concerned with what a newspaper article comes out about, JP Morgan is going to do this, or we're hearing about George Soros's intentions. If we don't see it happening in the market, we're not interested. So this is always that nice realization of that. And so it's very important that we have to wait for the market to produce that actual signal. So what I mean by this is we could see there was some bullishness starting to creep in here, which meant that the trend was losing steam. But that is absolutely not enough reason for us to become a buyer or to exit our trades. It's really just saying that the conditions are changing, and therefore there is now a possibility of a change in trend or a consolidation. So we actually have to wait for the market to produce that. So for example, in this case, we had to wait for price to break through that and shift into a downtrend. Then we can become sellers. We absolutely don't count our chickens before they hatch. We wait for price to do it. So the indicator is a really good kind of tool that is hinting that something will happen. Before we take action, we need to see that behavior confirmed in the price action. So again, you might have a downtrend that's coming down and it starts slowing down. You might get a double bottom or a triple bottom, and you're looking for price and you're getting that bullish divergence. So your indicator was bearish, now it's bullish, and you're waiting to see if price is going to go into an uptrend. So you need to see that first. And the most aggressive traders might get in on a break above this high or a pullback and looking for this to go to the upside. Basically, as you become more and more experienced as a trader, ladies and gentlemen, your confidence is peaking. So in other words, you know kind of what the market's likely to do. You tend to be able to read price action, what its immediate intentions are, and you're so comfortable doing that you're okay with a few losing trades because you're right much more often than you're wrong. And so especially that. So we need to see these kind of things happening. So euro dollar has switched into an uptrend, come back and tested this, and is now trying to decide if it's going to go any further. So I wanted to introduce you to the two indicators. I use them as a double confirmation. We've got our moving averages, which are fantastic for helping either locate entries into a trend. So if there's a trend in place already, often price will interact with the 10 and 20, these two moving averages together, and that becomes a really good place to identify a location where I can join a trend. When it's like this, it's not worth trading, because here you've got price going sideways, you've got the moving averages in the background. It looks like all those cables under your desk. Okay, it's really not where I want to be. It's very choppy. I'm looking for trends and looking to trade with those. And right now the market's going largely sideways. So I'm looking for it to break out and carry on trending, or break down and potentially come back down to this low here. Okay, cool. So we've done that. Let's go and have a look at the, first of all, I'm going to get rid of you. I don't need you. Let's go ahead and do the S&P 500. Let's bring it on. And now, first of all, let's get some context, please. Okay, so we have to wait. We'll just get a bit of history here. So I want to see what we've got. We've actually got a lot of history on this. I love it. So this is the monthly chart, and we can see that the market has continued to trend higher. And the monthly chart, you might not think that it's relevant potentially, because maybe you prefer to trade the 5 minutes or the 15 minutes, but the monthly gives us an incredible amount of perspective, and especially when it comes to investing. And we're not, strictly speaking, we're not talking about investing now, we're talking about trading. So investing, I'm going to give you a very quick definition of it. Investing is when we have surplus cash, we can put it away. Instead of in the bank or in a property, we can decide to put it in stocks, for example, and we then need that market to increase in value. Excuse me for 1 second. Okay, so then we can put that money aside for a longer period of time. We need that market to go up in value, and this is similar to in the way that we would invest in property. So the thing is that we have time. We usually will look for a market that will tend to go up. So we're not going to invest in currencies because currencies can go all over the place. We'll tend to invest in stocks, or maybe we want to invest in cryptos if we're a little bit edgy, or we'll invest in property, as I said. So, and this is where we have that expectation that it's going to go up. And often this is a longer period activity, kind of 3 months, 6 months, 1 year, 5 years, or more. Trading, ladies and gentlemen, is when this is now a job for us. We need to earn. In addition to maybe investing, we actually need to earn a paycheck every single month. So we need to be looking for opportunities where we can bank those profits every month. And so this means we start looking for opportunities today for the next few hours, or this week. Next week, I'll start again. And the week after that, I'll start again. But the idea is by the end of the month, I've earned enough to cover my costs. And so I'm really only looking for much more shorter term opportunities, which means that I'm often selling if the market is heading down, or buying. Now, most of the time the markets are heading up. They spend a good 70% of their lives, especially the US markets, trending higher. Bear markets and corrections do not happen. The majority of the time, they can happen less than 20% of the time. So most of the time, the market is going to head up, and historically, it'll tend to keep going. So today, why I talk about that is because I want perspective. You'll notice how often the market will pull back into the 10 and 20 moving averages and then head out. So you can see it pulling back here, and it pulls back here. There's a couple of areas where it pulls back down to the 50-period moving average. Also, during COVID, we had quite a strong correction. The market recovered very quickly. So we had 2 months down, 3 or 4 months up to get back up to the old highs. And we often get that period where it moves away from the moving averages and comes back. Okay, so the next thing that I want you to observe here, please, is that the angle. So when a market is, the most kind of sustainable trend that a market has is just kind of a very steady, slow kind of, it's not 45 degrees, it's probably 35 to 40 degrees. Now, as it starts to accelerate, so you can kind of see here, it then starts to accelerate here, and then it gets up at its steepest here. So we often refer to that as going parabolic. The problem with parabolics, and this is a general rule of thumb, is that the market tends to get exhausted. It's injected much more average energy than usual, and we often have a correction that is as steep. So if you kind of drew a line running through roughly the original trajectory of what that original stable angle was, we often have a correction back down to get us back down in line with that original trajectory. That means the market kind of got a little bit too fat for itself, and then it lost all that weight and it comes back down, back in here. So this is an area. So if I do that, we've come back down. We haven't connected with the 50-period moving average here, which is not something that happens very often. I would say that it happens in most cases where we have a deeper correction. We are having a deeper correction now. We haven't quite connected with it here. I would really have preferred for the market to come back here and then subsequently head off. So let's talk a little bit about what's going on in the world at the moment. Okay, it's very important to first of all acknowledge, so let's get some perspective again, is that inflation always occurs at the end of a bull market. In other words, at the end of a bull market, there's always a point where everybody has started to make quite a bit of money, or the cost of things have started to go up, and then the cost of things have maybe got a little bit too high for people. And that, in 2007, 2009, that triggered a lot of people defaulting on their home loans because the interest rates are low and they'd expose themselves too much financially. That was a very common kind of occurrence. And so inflation actually is something that occurs always at the end of every big move. And usually what that then causes most central banks to do is to start to hike interest rates, which then triggers a correction. Okay, so first of all, what the banks as a general rule are supposed to do, and they used to do this more in the 40s, 50s, 60s, and 70s, is actually during this period when the market was booming, that's where they would slowly start to increase the rate hike. So what they would do is, instead of the market going all the way up like this, it would start to level out, and you wouldn't have inflation be as bad as it is. But inflation is always going to be at the tail end of every single bull market before it has a correction, which then leads to banks upping those interest rates, which then usually triggers a bit of a correction in the market. So why is that? Well, first of all, especially since the year 2000, there's been a lot more stimulus cash, especially in the US and in other parts of the world, has been going into the markets. And companies have been doing this, central banks have been doing this, governments have been doing this, and big institutions get access to a lot of this money where either the interest rates are very low or none at all. So it's really makes it, the best thing that they get to do is they get to borrow hundreds of millions or possibly even billions and put it into the stock market. It's one of the things that they can do. There's nothing stopping them from doing that. So they'll often put that into the stock market. So you get a lot of companies and individuals who apply for that will then put a lot of that money in. Lower interest rates, they can borrow the money as well. It goes into the stock market. That creates a lot of the drive in the market, which then also attracts other people with money and so on and so forth. But that is one of that's one of the central kind of injections into the stock market. And so when the interest rates start to go up, then what happens is their loans they start to look at the maths of it and the accounting and go, okay, is it really worth our while to now perhaps we should start to bring some of that, extricate ourselves from those positions. And so that's why I'm saying you start to see a bit of a correction, because a lot of the institutions that have borrowed money, they now start to look at it and go, you know what, we should start to take some profits and start to extricate some of that borrowed money out of the market so that we might have to pay it back. And we also want to make sure we get out of that. So they definitely don't want to be carrying that as a debt. And so that is definitely also one of the drivers where you start to get a bit of a correction. But obviously people who bought at the top here start panicking and selling here. So you get all these different it's layers of activity. All right, it's almost like snowballing, or layers like an onion, where some of it's big institutional, some of it's professional, some of it's retail, educated retail, and some of it's kind of uneducated retail. You get a mixture of those. So the reason I tell you this is because, yes, we have actually shed a lot of this kind of unnecessary weight that we had up here. And there are, we could come back down a little bit further. So if you've ever seen The Big Short, if you haven't seen the movie The Big Short, you absolutely should. It's a phenomenal film anyway, not just because of what it talks about. It's just a great film. And in that, Christian Bale plays Michael Burry, based on a true story. This guy's just very clever, crunching the numbers, and he at the moment is very much convinced that that this is really just kind of the first part of the correction, that subsequently it could trigger a deeper correction, meaning that if we stay at this level too long, then companies might have to lay off a few people, which then might trigger a recession, which then might trigger a few other things. Okay, so their concern really is that in a way, with all the stimulus cash, what you're kind of doing is buying stuff on credit card. Okay, that's kind of like using your parents' credit card to buy stuff, or just your own credit card. At some point, you're going to have to pay off the credit card. And so this is the concern. And Ray Dalio of Bridgewater Associates, who's also very successful, his concern is exactly the same. They're essentially concerned that we haven't really solved around the world, that we haven't really got to a point we do need to up those interest rates anyway. And upping the interest rates, the whole idea of that is really to start paying off debt and to help kind of keep people's spending under control. But if you do it too late, then people have spent too much and they can't afford to pay it off. So that's why you generally want to start kind of doing it sooner. And so the problem they have now is because they've been dropping interest rates to stimulate growth, and the growth has been going really well. When you get to a certain point where the whole world has become accustomed to low interest rates. So what do I mean by that? I mean like 2% or 3 or 4%. When I was a kid, and also when I grew up in South Africa, we had interest rates of 14%, even before I came over, 15% when I came over in 2008. So South Africa, for example, has got a much higher interest rate. And that was normal on your mortgage payments. And then you come over here and it's 2.4, 3.4, maybe 5%. And at 5%, that's kind of a sweet spot. Once it starts going above that, then it's a bit of, life gets a bit expensive, and there's fears of triggering that. So this is kind of where we sit at the moment. Here's the other problem, though, is that we've never really been in a situation like this before, where we have great amounts of economic growth. There really is, there's low unemployment at this time. And the reason what makes this unusual is that we have COVID. So COVID and the war in Ukraine, Russia invading Ukraine, are really the two biggest things that have ultimately triggered this inflation. That's kind of what's been the kindle that kind of got it all started. And so one of the things we have to do is imagine that if there was a resolution to the war in Ukraine, hopefully soon, and we managed to be able to put COVID in the rearview mirror, then we would actually be able to look back and go, okay, how bad are things? Because those two things have they've triggered inflation, and they are still contributing to it because of supply chain issues. So the other problem we have is that we now have other strains of COVID. So COVID actually, I don't mean to be pessimistic, but it doesn't appear as though it's going away anytime soon. It looks as though we're still going to have it for the foreseeable future. What I would hope is that we at least can get it more under control and maybe just keep it down. But it does look as though we've got some other stuff coming up. So we have to just be aware of that. In other words, we might have to go back into wearing masks and hopefully not another quarantine, but we're going to have to see how that goes. And so all of those things could actually add additional strain, which could cause the markets to go down. Sorry about that. So I want to remain optimistic. I do believe that over a big enough period, over a big enough time frame, it's better to be optimistic, to believe that the market will go up. So Peter Lynch, who's a phenomenal investor, he wrote a fantastic book called One Up on Wall Street. Obviously, Warren Buffett, you probably know, his partner, Charlie Munger. You know, they're of the opinion that you never sell. Okay, you never sell. If there's a market crash, you either hold or you buy, but you never ever sell. In other words, you should always see a market crash as an opportunity to buy if you are in a position to do that. Okay, so to come back to the technical analysis of this, we have essentially come back to the earliest point at which the market could recover. We've given off a great amount of much needed fat. We've lost weight is what I mean by that, and we could and so it is possible for us to recover from this. Usually what would happen is we would get a bit of a correction, we get a nice little green candle, and then we recover from that. The next candle breaks the high and it starts to take off. Here we had a bit of a green candle, but it didn't break the high. The next one produced a green candle, we broke the high and we started up. Same thing again here, same thing again here, same thing again here, even here arguably. So we had another one here where we didn't break the high. So this one is the same as, where was the one that it was over here? Like that one there. It was the same as that one there. And here's our second one. Okay, so this is the same as this one here. Now, it's not a guarantee, but it happens frequently enough in the past that it's also not a crazy idea. It's not a crazy idea that if we finish this month with a really nice green candle, that this could be the beginning of the next leg up. And so we're taking a shorter / medium term approach to that. So this is important. I draw this up because you really only are going to be able to just get this idea, this perspective, when you have a look at the monthly. And here again, I wanted to just highlight, you can see that MACD is trending higher. You can see here the RSI is not looking great. Overall, from this, so the way we'd like to do it to keep it fresh is we measure the most recent highs. And we can see at that point, definitely we have got high highs, and here we've got higher highs as well. So there we've got high highs. So generally speaking, what it's saying is the market is bullish. The trend is not showing us any divergence. And I'm going to show you now on a lower time frame. We'll go back to that. Okay. Let's go back to the weekly. Let's start to have a look here. Actually, the daily does it a little bit better here. And then we'll just come back here. Zoom out a little bit, zoom in a little bit. Okay, and so this is how we can kind of do it. We can see that generally we've got price trending higher. We get to this area here, so I'm going to start to show you this. There's a higher high there. There's also a little bit of a high high here. And then of course there's higher highs there. So if we generally just want to go from there to there. But what you'll notice at that time is that although we are producing a high high here, let's clean it up a little bit. So although this is clearly a much higher high than these ones here, we've gone up, we've actually started to drop down on both sides. Okay, so what that means is that if you got back to say this point, so I'll draw a line. So you didn't have to see anything to the right-hand side of that. You didn't have to see anything to the right-hand side of that. But what that would do is tell you that when price, you see how often price pulls back to the moving averages and heads away. I like to think of it as a train station. Price pulls into the train station, heads away. We could see the price pull back here, headed off, pull back here, headed off, pull back again. So your expectation normally would be that it would head away from here. However, this is where it's alerting you to this. It's saying, look, first of all, although this is where you might want to get on, it's telling you that at this point, there's bearish divergence on both indicators, meaning that the market is tired. It doesn't guarantee the market's going to go down from here. It's just saying the trend could start to fail where it is. And this is very reliable. And this would work on the 1 minute. It'll work on the 5 minute, 50 minute, 1 hour, 4 hour. It works on everything. And this is really where it started to give clues on that. So what happened after that? So after that, we then started to break below these lows. So the rule is, it's called market structure. when you have a trend to the upside, you get these series of high lows and high highs. Because at each point where some people who are buying here take some profit and get out, or maybe people who have to sell, push down, the buyers come in and the buyers are actually strong enough here to push it up. Not only do they push it up from this point, but they also push it up and break above the old highs and they push it up. Then it does the same thing again, and you get buyers, other buyers or new buyers or the same buyers coming back in and pushing here. And again, they push it up and they break it to a new high. And at some point, if the market drops below that, that means that the buyers who were here are no longer here. They're not here anymore. And so that tells you, okay, something's different. So then what happens is the market will potentially try to get back up to those old highs, but it could fail. It could sort of get in here or anywhere here and produce a lower high. And it's really when it breaks that low. So let's go ahead and just draw this again. So we sort of have this nice uptrend and here, and then price comes down and breaks this low. And then it could try to do it, maybe gets a lower high. It's when it starts to break below here that you start to get that confirmed downtrend. So if you think about it, now the market is not even strong enough to get up here, but it's also starting to break to fresh lows here. So those are all very significant stages that happen. And so we could see that actually here we had these high lows, high lows, high lows. If you want to argue that, doesn't matter if you could include this one. We then fell through that one. We tried to come back up, we couldn't. And here we started to break through these. So we started to break below that and then break below it. So then we tried again and couldn't actually get past that point. And then again, came back and broke below that, and then tried to get up here and couldn't do that and broke below that one. So all of that brings us closer to where we kind of are at the moment. So that's how we went and started to go from a bull market into a bear market. Now, we don't really worry about the moving average crossovers too much. They can be seen as a general guide. So generally, if the 50 is above the 200, it's nice. It's generally a bull market. If the 50 is below the 200, you could say it's a bear market. I would kind of say to you that, you know, if we look at, say, the weekly, for example, if price is above the 50, it's a bull market. If price is below the 50, it's a bear market. I think that's just a much cleaner way of doing it, rather than two different moving averages. So we go back to the daily here, and I want you to have a look at what we see here. So we've got a bit of this kind of extension. So what's changed currently on the daily is that we have these high lows and high highs. It's trying to push up. So when you have on a higher time frame, you have this behavior. If you zoom in on a lower time frame, you get little waves within that. And then here you get a temporary downtrend. And then it goes into an uptrend. And you have a temporary downtrend. So what we could have here, which we don't know just yet, we could have a temporary uptrend, which is really just part of the next move down. Does that make sense? So we've got the bigger move down, and then occasionally it'll do a temporary uptrend. The bigger picture is going down, the smaller picture goes into a temporary uptrend and then back into a downtrend. We're not that clear yet, and that's what I want you to take away from this. Is we're gonna talk about what we need to see. So basically, this is what I want you to think about. We've got price above the red 50 moving average, generally speaking. Often when there's a bit of a spook in the market, this is a weekly time frame. It's important that we do this on the weekly. The weekly is important here. When we have a bit of an issue such as COVID, we drop below that 50, and then we manage to get back up above it. Okay, we are underneath the 50. I think it's very fair to say that once we get back up above the 50, we pretty much settle down and start to resume a move to the upside. That's what I want you to just think about. Okay, so right now, we are still beneath that 50 moving average. It is going to come down and meet us. It's going to come down here as price tries to go up. The next thing we have, just mentioning it, is we're still pretty much in a downtrend on price action. So I'm going to give you a list here, which is multiple things we need to see, and then you can go, okay, well, that's happened, that's happened, that's happened, and that's happened. Right, we should be fine now. And we're going to do this in real time. In other words, I hope that I'm still doing webinars with you guys in the next, 6 months time, and we can, or 3 months time, and if we do move to the upside, I'm here when it happens, just for the sake of fun. So what I need to do, first of all, there's a couple of other things. Remember how I spoke to you about an uptrend starting to break structure. So if I can see price break above a previous high, that also should mean that the sellers are now not necessarily in control, and maybe buyers are starting to come in. So that would be this high over here. That's what I need to see. That's one thing I definitely want to see. At that point, the 50 moving average is probably going to come down here, which means price might actually start to get above the 50 or at the same time it breaks that previous high. The next thing is if I see an uptrend. So I see a downtrend, then go into an uptrend, which means I see a low, a higher low, and a high high. That's an uptrend. So sometimes that could happen like this. Price could break straight up, come back down, test it, carry on. Or you might get a situation where it sort of did this and breaks up. There's different ways in which it can happen. So that's what I need to see. I need to see a higher low and a higher high. And again, so that's in an uptrend, breaking that, and the moment it passes the 50 moving average. If those three things generally occur, I would say that it is as safe as it can be to say, okay, we're pretty much back into a bull market trend. And what that does is if you look at the chart as it is now, looking at where this is and where this is, we've got time before we get there. We're still technically in a downtrend. So we have to break that, or we have to produce a high, low, high, high, and break that. There's a whole lot of things that have to happen, and they will probably all occur at exactly the same time, meaning it's not a trick. It's just saying that they often do tend to occur all at the same time. Okay, it's just the way things happen. So that is something that I want to see happen right now. We're still currently just correcting to the upside. I would say it's looking really nice and bullish. And I also need to see how the monthly candle ends. So we're taking a big picture perspective. We have had a nice correction. Yes, is it possible we could do another leg down? So the worst case scenario, which to me is not necessarily the most terrible thing, is that we could do another leg down, meaning that we could probably come as far down as this. Is that guaranteed? Michael Burry is really good. I trust both him and I've just blanked on the other guy that I mentioned. I'll get it, Dory. Ray Dalio. They're both really seasoned guys, and so I do trust their judgment. But we could see the market. We have certain things that even they acknowledge are very good, that they're surprised by, which is the low unemployment and so on. There's a couple of other things. So even they're going, okay, that's better than I would have expected. So there is a possibility we could recover here, and then that issue that they're concerned about could be something. They've also said that, by the way, if the government works to reduce its debt and does try to increase interest rates and try to keep everything stable, then we'll be fine. So that is important that we think about that. The other concern they have is that we could go into a period called stagflation, which means we still have some high inflation, but we don't really have any job growth. So the job growth stays where it is. It just stays low, or it just starts to go up a little bit, or I mean, unemployment goes up a bit, and we just still have a bit of high inflation. So that is also a big fear. So anyway, the point is that I want to see what happens here, and if we do recover, we do go back up to the old highs. The charts will tell us it first. So really, when the market is doing it, then at the end of the month, the government gives out the stats saying, okay, we've seen the markets recover. All right, we see inflation is still a problem. So remember that a lot of information we get is after the charts have done their move. In other words, that's the data. But the charts are giving us the real-time feedback. Cool. So let's have a look. So that is a very real possibility. That's what I want to have a look at. We are still within a downtrend on the weekly. And this is what I'm going to need to see. I need to see. Sorry, let's just do that. I want to see this break above this high. So I need to see that break above comfortably and stay, by the way, stay above 4.2. Let's call it 4,200. So that's great. Let's have a look at the Nasdaq. So let's go, tech stocks. Let's see, because tech stocks, by the way, have had some of the best growth in the last 10 years. They've had the most growth. They have absolutely gone parabolic, meaning that monthly chart has just gone right up. And so the tech stocks have also shed a lot more weight because they had the most growth. It's such a simplification. I get it. I appreciate that. But it is also kind of true. And again, they could come a little bit further down if we're not done. But again, they've also come very close to the 50-period moving average in both cases. And so remember, that was COVID. We thought the world was ending and the market recovered. So even though we've dropped down now, we can recover. It can happen. It just doesn't always feel like it at the bottom. So in other words, instead of me saying, oh, it's definitely not going to happen or it's definitely going to happen, I'm going, if the chart is doing this, we're recovering. If it fails to do it, then we're still kind of going to be in this boat. But that looks really good. So if we now go across and have a look at the Dow to compare this, I want to compare all of these so that you can get a sense of the three US ones. Then I want to start to have a look at those individuals. But what I said about that on that weekly chart and price action and the trend and the 50-period moving average and breaking previous highs, that's as close as you can get to a blueprint for this market is now back into a bull market. So you can see we've let off some steam so far. It looks okay. we might have trouble up ahead. You know, we might recover from here, and then next year we still have inflation, or the war is still a problem. We have other things, and that could be the case. But we could also at this point be at the end of whatever has caused all the different things that have caused this. We'll have to see how that goes. Because in a way, what can happen is the markets can become used to high inflation or higher inflation, and they can become used to the war, and then they just muddle through. It can happen. In the past, we have had the markets grow under higher inflation. So it can happen. We'll see. So let's compare that then. So we've got the Russell 2000, which is the small cap companies. I apologize that the data is so nice and slow. Let's throw in a couple of these others as well. So let's bring that in. Let's bring in the DAX. These can be, we'll just do weekly for now. Get it. I want to do monthly as well. I want to do these ones monthly. And let's go back and have a look at this. So the Russell 2000 has come back into this old level of highs to potentially find support there. So far that looks pretty good. And previously it's been down here. So overall, again, it's a correction back down to the old highs. That's not bad. Again, this could just be a first stop, and there might be one more leg down towards here. All of that really, to me, we're not saving lives here. This is just human-made markets. It's not necessarily too much of a concern. Our main concern is, what does that do to, you know, for employment and stuff? But generally speaking, within a few years, the markets will get back up to their old highs, generally, okay? Based off all the things that have happened in the past, excluding the 1929 stock crash, excluding that. So, you know, there are exceptions, but generally speaking, the markets can be trusted to ultimately recover, which is why we don't really want to panic. So then we have, say, for example, the FTSE, which actually is has always battled with its own sort of 7,000 levels, really that kind of area there. And we're back here. We're still, you know, it hasn't, you don't get as much growth in the UK as you do in the US. And so it's kind of stuck within this range. I'm not too worried about that. You've got the DAX here, which is back down at its old highs, just dropped below that, but still at it where the previous level support is. So we could argue that this is fair enough, is kind of that last stand. If the markets do fall through here, then there might be a bit more panic, which could cause a bit of a correction. And it always don't think that the markets are logical and rational. They can be incredibly emotional and overreact often. They can be too buoyant when the market isn't actually that great, and they can drop too far when the market's not that bad. And then we'll look at the ASX, the Australian one, and while that's loading up, let's start to have a look at a few of these. So let's go through them in order. So we'll start with Facebook, which will be our, this is Meta. This seems right. We'll let that, is that right? It does look good. It's only Meta, if it is right, Meta Platforms, which I think it is. It's only been going for a small period, so we only have that history, which is annoying. Let's see if oh no, I don't have it on the other platform. Okay, fine, forget about them. We'll go and have a look at the others. So we've got Apple. Let's bring in Apple. Let's bring in Amazon. It's gonna be our monthly. Let's look at Netflix. Just let that data load up so I can have a look at these ones. Let's look at, did we do Google? Do a couple of those ones. And then we'll have a look at a few of the others. Are you guys finding this useful? Are you finding this instructive? We'll look at Tesla. Give me some feedback. Oh, and so also, by the way, I meant to say, this is very important, but one of the cogs in the system that I haven't spoken about yet is the dollar. So basically, when a central bank increases their rate hikes, it tends to strengthen a currency. And so it's not just about panicking and seeing a safe haven moves. It generally has resulted in a stronger dollar. We've also had a weaker euro. And so what we've been seeing lately is a strong dollar tied to that inflation, which is triggered by the war and COVID. And we haven't seen any safe haven moves to gold, which is why I wanted to show you gold, because it's not featuring any safe haven behavior at this time. Okay, this is a monthly chart for gold. It's dropping down. There's no safe haven behavior at this time. If we are going to have, you know, if somehow we're in the eye of the storm and we think that it's done, but actually we're only halfway through, then we might maybe see a bit of a reaction, but we're not seeing it yet. So all of that is a good thing. It means that the big institutions are shedding a bit of weight, but they're not buying up gold. No one's buying up gold. And so therefore they're not really panicking too much about it. In fact, anything, the stronger dollar will push gold down. So right now, what's causing gold to go down is more a stronger US dollar than it is fear or panic, if that makes any sense. Hedge against inflation. So again, we can go ahead and have a look at crude oil. So let's go through some of these. How's Apple doing? Okay, so that obviously doesn't look right to me. So that data doesn't look great, but if we go ahead and have a look at the daily, we can see here we've got a strong trend. We've broken that high. Okay, let's see what it looks like from a weekly perspective. Okay, we're still on a bit of, we started to break through that high. So that is a good sign with that data. Let's have a look at Amazon. So Amazon had a nice correction down to here. Nice little bullish candle back into the old highs. This is a good breakout and a retest of support. So that's also a potential valid setup to continue back to the upside. Netflix, obviously right back down here. It's actually overextended to the downside. And what that means is that this, at the very least, it's got different challenges ahead of it. Here, it's probably going to be able to easily make it back up to this area. And then we're going to see if it has enough strength to break through that, what was support, if it's going to encounter resistance. On the other hand, if it manages to just slice through it, the next level is 380, I beg your pardon. That's where it's going to then have its next challenge. Okay, so that is going to be Netflix's Google, but so far all of these look like they still have more room to the upside currently by the end of the month. We've got Google, really nice, healthy retracement back down here to the old lows and producing a bullish candle. So most of their businesses are still pretty stable. There's no reason why their business models will change. We're still using technology as much as we were a year ago. If anything, we're doing more of that. So we still use it. I just think technology was possibly overpriced. And therefore, the correction we're seeing is more of an overvaluation, not the fact that we're not using the products, the underlying products. Okay, so that's kind of my personal opinion. Microsoft, I wanted to show you because Microsoft, this is a bit of a spike in the data. Look how steady their MACD is. This is where we start to see a little bit of it running out of steam, meaning that the last part of it here is just, it's running very hard. But I want to show you how stable it is historically. So my logic is this, is that when we see the bigger companies that have been generally very stable start to recover, you might have a few that lag and some that aren't as strong or healthy. But if the big ones are starting to recover, then that's a good sign. So again, we look at Tesla. Just look how Tesla's come into this old level of support, finding it's already produced a swing low. So it's already broken the high of June. It's looking nice and bullish. And the next one up for that, for Tesla, then puts it back up at, what's it, 1152. Okay, so that's good. I've got a slice of Tesla as well. Gold is back down at the lows, and crude oil I wanted to show you as well. So if we just crude oil, we don't have a huge amount of data on it. Generally speaking, it's just staying where it is. And again, crude oil and gold, it's under that dollar pressure. So that's what's keeping commodities down at the moment. Okay. Generally speaking, I expect them over, the next year or two to continue to climb. But here I just wanted you to see the difference between them. Also, we've got ARK, Cathie Wood's ARK, which is just a great little ETF. An ETF is basically a collection of stocks that a company will then put together. So they'll select it. And Cathie Wood's ARK has got technology stocks, which has been taking a hit from, similar to Netflix and similar to a few other things, it's been taking a little bit of a hit. And then that was it. I really wanted to take you through all those. Let me have a look at your questions and comments, and then we can wrap up. If you have any other last questions before we do, then just let me know. What are your questions? Let's just have a look at these ones here. Oh, good. Thank you, Charles. Appreciate that. Okay, great. So far, it seems fine. Okay, that's good. Yeah, so it's a lot I want to kind of convey. I think it's really exciting. I'm not trying to be blind to a worst case scenario, not at all. I guess my logic is this. I'm going, if Warren Buffett isn't nervous, then I'm not nervous. And he's definitely been around long enough to have seen a lot of different things. So if he's nervous, that's fine. And he acknowledges the inflationary issues. He knows all those, but he has a slightly different perspective on it. And he's got thousands of employees. So, it's really, I've always got these people like the canary in the gold mine. That's who I'm looking at. Different people that I'll do the technical analysis, and I'll look to see if anyone else has any other concerns, because they'll be looking at the numbers, and then I'll talk you through it. So I'll kind of save you the work. But yeah, I wanted to kind of take you through this. I love it. I think it's looking good. I'm relatively optimistic. But just, to have that confirmation, if we go back through this and have a look at that S&P and have that S&P start to break, bring that 50 back down, have price do it, then we would start to break above it. And so I think August is going to be a telling month. If we close up near the highs or break these highs, then the next month can probably do that. So we're looking at somewhere between, if we're going to break up from here, we're looking at about a 4 to 8 week period, probably. That's a guesstimate, where we'll start to work our way to that side. So we'll have about 4 to 8 candles where we'll have to break above here and have this come down and then start to breach it. So we're not going to see it anytime soon. In fact, technically, we can have all the way through to October. We don't have to. It doesn't have to be resolved immediately. What I do want to do is just check those unemployment numbers. That's really what I want to keep my eye on, because upping the interest rate will start to curb spending, but I don't want to see companies starting to lay off people. So that for me is really kind of the thing that I want to keep an eye on. Yeah, and so the goal is we'll be doing these, either myself or one of my amazing colleagues will be doing, we all see the same things, but they have sometimes additional experience and takes on it. And then just basically the idea is that every few weeks or every week or two, you'd be getting an update on this as it unfolds. Yeah. And great, so markets to watch. And so I say that the dollar's driven a lot. The dollar has pushed euro down, cable down, the Aussie down. It's pushed, it boosted the dollar yen as well. But also Bank of Japan have had a weakening yen. So that's another layer of activity that's unrelated, but just doing its own thing. And then we've got that strong dollar pushing commodities down. We've seen that actually started, that's also been improved by the inflation, which has also caused stocks to start to drop. So all of those, and when I say things were connected, that isn't always the case, but there are times when under certain global conditions, panic or fear, then suddenly things are connected. All of a sudden there is a move to gold and there is a stronger dollar, or there is all these different things. And it isn't always the case. When life is good, things can do their own thing. It's only when life gets bad, suddenly everybody starts kind of checking what the left hand is doing and what the right hand's doing. So there we go. That was an absolute pleasure. I really enjoyed doing that. Ladies and gents, we've sort of arrived, come to the end. I was going to say to you, these are always recorded. And I appreciate that I speak very quickly, especially if I get excited. It is recorded. Sometimes you get an email, I think, that tells you it's recording and you can get an access to that recording. But if you have any issues, and you don't get any prompts in the next 24 hours, please send an email to me and I will simply send you a link to the recording. Send it through to Adam at Trade with Precision. Okay, and I will send you a copy of the link of the recording if you want. And that's it. I want to wish you basically a weekend's coming up. I want to wish you a wonderful evening and a wonderful weekend. And I look forward to chatting with you in future webinars. Thank you so much. I do appreciate your time and I love the interaction. So thank you very much. Take care.